Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Enbridge's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Enbridge owns, transports, and stores crude oil, natural gas, and renewable energy. To put it simply, it makes money by storing and moving energy through its pipeline to various customers in the US and Canada. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1949. The ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 109 billion market cap. They're trading at $54 a share, and they have 2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a lot of free cash flow in 2020, over $4 billion. It did decrease a lot even though their revenue went up. It appears they're investing more in CapEx. That's why they have less free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's highest in 2021 and the trailing 12 months, over $6 billion. Revenue is a sales for the company, and that's pretty flat from 2019 to the trailing 12 months, lowest in 2020. All the numbers in this video are in Canadian dollars since we're looking at the ticker that trades on the TSX. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. Their gross profit is pretty steady each year. So even though they had the same revenue as 2019, their gross profit was much lower. So their margins are much higher in 2019 compared to the trailing 12 months. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Examples are R&D and marketing. Gross profit minus operating expenses gives you your operating income. And that's also pretty steady each year. It was 8.7 billion, down to 7.7 billion. They spent 2.8 billion of interest on their debt, which is pretty similar to prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When they sell an asset, the gain on that sale goes into other income and expenses. They had a big gain in the trailing 12 months, 2.9 billion. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is highest in the trailing 12 months at 6.4 billion, much higher than 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that's pretty steady year to year, 9.6 billion in the trailing 12 months, highest in 2020 at 9.8 billion. You can see they spent a lot on CapEx in 2021 and the trailing 12 months, 7 billion and 8 billion. CapEx is investments in property, plant, and equipment. The cost to construct a pipeline goes into CapEx, and that dollar amount is carried on the balance sheet and depreciated onto the income statement over its useful life. Operating cash flow minus CapEx gives you your free cash flow, and it was a lot higher in 2019 and 2020 because they had lower CapEx. They do add a lot of debt each year. They added 13 billion in the trailing 12 months, 11.4 billion in 2021, 5 billion and 6 billion. They do pay down debt, but not nearly as much as they issue. Let's look at their capital structure. 62 billion of equity, 76 billion of debt. They're 45% equity, 55% debt. Their net debt is 76 billion. And their WACC on Finbox ranges from 9.5% to 11.5%. I gave them the lowest WACC of 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value to all cash flows past year 4, that's 83 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $73 billion. We divide that by 2 billion shares. And we get a calculated stock price of $36. They're trading at $54, so they're trading at a 50% premium. It's a sell according to the model. Their revenue target in 2024 is 56 billion Canadian dollars. In 2023, it's $47 billion. In 2022, it's $51 billion. I continue this growth into 2025 and I got $64 billion. That's how I got their future revenue estimates. In 2019 and 2020, they converted 9% of their revenue into free cash flow, so I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. The website Simply Wall Street's valuation is $71, and they're saying the stock is 24% undervalued. 12 analysts priced the American stock, and their price target is 49. The low is 43, the high is 62. This is where the stock has been trading the last 5 years. Midstream companies tend to be a lot safer than downstream or upstream, but you can see this stock moves all over the place. Before COVID, it was about $56 a share. By the end of 2020, it was in the low 30s. Then it doubled since that point, but in the past couple of weeks, the bear market has hurt this stock a little bit. It's down a few points at $53. But you can see they pay their consistent dividend. They haven't cut their dividend even during COVID. In the past year, this stock is up 9%, while the price of Brent crude is up 50%. You can see they were tracking each other for a few months, but Brent crude shot up, while this stock really didn't move too much. They pay a quarterly dividend that they raise each year from 61 cents in 2017 to 86 cents in 2022. They pay a nice yield of 6.4%, which is 272% of their free cash flow, 110% of their net income. But they're investing a lot back into their business, so their free cash flow should be higher in future years. Their yield was a lot lower in 2011 to 2018, around 4 to 6%. Then the yield shot up to 8% when the stock price came down. Right now it's sitting around 6%, and the forecast is for the yield to be 6.8% by 2024. The last time they did a stock split was 11 years ago in 2011, a 2-for-1. Before that in 2005, a 2-for-1. Before that in 99, another 2-for-1. They have a beta of 0.9, so the stock moves a little less than the market. It's not too volatile. It's up 9.5% in the past 52 weeks, while the S&P is down 9%. The 52-week low is 47, the high is 60. And the stock is trading between its 50-day and 200-day moving average. This is a fairly popular stock. 10 million shares are traded each day. Pretty much all the shares outstanding are on float. 53% are held by institutions, and 4% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $17,000 today. That's a 67% return, a 5% annual return. The CEO's annual salary is pretty steady at $1.6 million, but their total compensation has been rising. It's 19 million Canadian dollars. Here's the insider trading activity the past 12 months. There was a buy for 500 shares, another buy for 1,000. But the sells are larger, a sell for 24,000 shares and another sell for 11,000 shares. 51% of the company is held by institutions, 49% by the general public, and only 0.2% by insiders. Their employee count is up since 2016, but down since 2018 and 2020. They're currently at 10,900 workers. The biggest shareholder is Bank of Montreal at 4%, then Vanguard, RBC, GQG, RBC, Capital Research, TD, lots of acronyms, RREEF, and 1832. Let's look at their financial ratios. They have a good PE at 17, that's stock price over earnings per share. Price to sales of 2.2, price to book of 1.8. And their price to free cash flow doesn't look so great since they invested a lot in CapEx in the trailing 12 months. Their price to free cash flow is 43, that's stock price over free cash flow per share. Their return on invested capital is only 4.5%. They can cover their interest payments 3 times, an ROE of 10%, and they can only cover 70% of their current liabilities with their current assets. Quick ratio is 0.6. So the company does seem to be underfunded. They did generate $2.6 billion of free cash flow in the trailing 12 months, but they have negative $5 billion of working capital and they pay out $7 billion of dividend payments. So they're probably going to need to add some debt to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 59 companies in the same industry as Enbridge. And if Enbridge has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. All the numbers in this chart are in US dollars because we'll look at the Enbridge ticker that trades in the US. They invest the most in CapEx of all the companies. They have a good debt to equity ratio. The average is really bad. They pay a higher dividend than the average company. They generate lots of free cash flow, but a lot lower than Enterprise. They're the largest company on this list in terms of market cap. They have a better price to book, price to earnings, and price to sales, but a worse price to free cash flow. They do generate lots of revenue. Their 5-year annual revenue growth rate is only 6%, the average is 10%. Their ROA, net income over assets, is 4%, the average is 6%, and their ROE is higher than average. So to summarize, I have them trading at a 50% premium. Midstream stocks are less risky than upstream and downstream because midstream companies just transport and store oil. Upstream is the most risky because they have to actually pull the oil, which takes a lot of time and money. And sometimes you think there's more oil at a particular location than there actually is. And this is Canada's largest oil and gas company. So I think for a long-term hold, you should be fine. And getting that consistent dividend really helps. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratio is 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.